Welcome to the deep dive. Today we're tackling something that feels like a real puzzle in the investing world. Warren Buffett.
Ah, yes. The Oracle himself. Probably the greatest capital allocator we've ever seen, turning Berkshire Hathaway from, well, almost nothing into a giant.
Exactly.
Yeah.
And this guy is all about finding value, finding wonderful businesses, yet there's this huge asset class, real estate investment trusts, REITs, that he just seems to avoid.
Right.
Real estate builds massive wealth for so many people. So you have to ask, why does the ultimate wealth builder generally steer clear? It feels, I don't know, counterintuitive.
Yeah, it does on the surface. But our research, looking at what they've said and done, it suggests this isn't like a personal dislike of buildings or property.
Right.
It's more fundamental. It's a structural and mathematical incompatibility between how Berkshire operates their whole philosophy and the legal structure of a REIT. So our mission today is really to dig into that. We'll look at the core ideas of Buffett and Munger, how they view businesses, and then dissect how a REIT is actually put together legally. The goal is to see why these two models just don't mesh.
Not just what they avoid, but the deep why. Got it.
Exactly.
And, as we talk about these principles for you listening, if you're trying to gauge the overall market based on similar long-term value ideas, remember there's a tool available. You can search and download the iOS app Buffett Indicator from the Apple App Store. It helps track that market temperature.
Good point. It ties back to this value-centric view. Okay, so to understand the conflict, we have to start with Berkshire's own model, their blueprint. Let's call it the compounding castle.
A compounding castle. I like it. So let's unpack this. What's the foundation? You mentioned their view of a wonderful business is kind of radical.
Yeah, the core idea is simple but profound. When you buy even one share of stock, you should think about it as if you were buying the entire company outright.
So forget the ticker symbol, forget the daily price swings, focus purely on the business itself.
Precisely. It's all about the long-term economics. What's its intrinsic value?
Yeah.
How much cash does it actually generate? Can it keep doing that? That's the focus, not the stock market noise.
Okay. And once they understand the business, you said it needs to pass, what, 2 main filters?
That's right. 2 critical tests.
The first one everyone talks about, the economic moat.
Yes, the moat. It's basically a sustainable competitive advantage, something that protects the business, its castle, from competitors trying to take its profits.
Like a strong brand name. Or maybe being the lowest cost producer.
Exactly. Or network effects, regulatory advantages, things like that. And crucially, Buffett wants that moat to be durable. It needs to last. 5 years, 10 years, hopefully it's 20 years or more.
Okay, wait, hold on there. If a moat is so key, couldn't you argue that owning, say, the best corner lot in a booming city is a moat? Prime real estate. Why wouldn't that count?
That's a really important distinction. A prime location is definitely valuable, no question. But is it intrinsic to the business operation in the way Buffett thinks about moats? Often, no. Its value is often tied to external factors. Zoning laws, interest rates, local economic trends. Maybe a new highway gets built nearby or it doesn't. These things can change. They can erode that location advantage.
I see. So it's less controllable by the business itself.
Right. Buffett prefers moats that come from within the business's operations. Things management controls, things competitors can't easily replicate. Real estate value often feels more cyclical, more dependent on these outside forces.
Got it. That makes sense. Okay, so the moat is filter 1. What's the second filter?
This one is all about the people running the show, management as stewards.
Meaning, are they trustworthy? Honest?
Yes, that's essential. Honesty and integrity. But even more specifically, Buffett looks for one critical skill above all else in management: capital allocation.
How they decide what to do with the company's profits.
Exactly. After the business has the cash it needs to operate and grow organically, what do the managers do with the rest? Do they reinvest it smartly in things that earn high returns, like smart acquisitions or buying back stock when it's cheap?
Or do they just try to build a bigger empire, even if it doesn't make financial sense?
Precisely. They have to be, often using the float from their insurance businesses, basically, money they hold temporarily but don't own as a sort of tax-deferred long-term funding source for these investments, this internal tax-efficient compounding. That's the secret sauce.
So any business structure that fundamentally prevents that internal reinvestment, that forces the cash out.
Is immediately at a disadvantage in their eyes. It's structurally inferior for their goal, which is maximizing long-term compound growth.
Okay, I think I see the clash coming. We have the Berkshire model. Retain earnings, reinvest smartly, Compound internally. Now let's put the REIT structure next to it. You called it the REIT structural straitjacket.
Exactly, because the legal requirements for being a REIT, which are designed to give tax benefits, directly conflict with that Berkshire compounding model. The biggest issue, the absolute core of the conflict, is the 90% payout rule.
Right. To qualify as a REIT and avoid corporate taxes, they have to distribute at least 90% of their taxable income to shareholders as dividends.
Correct. Now, think about that from Berkshire's perspective.
If you're an individual investor looking for income, that 90% payout might sound great. Consistent dividends.
It's often why people buy REITs. But for Berkshire, they want to keep the cash inside the business to reinvest it. This rule forces the money out.
So it's like the business model has a mandatory leak.
A huge leak. That 90% rule basically prevents REIT management from performing what Buffett sees as their most crucial job: intelligently reinvesting retained earnings. The structure itself short-circuits the compounding engine.
It turns the business into, what did you call it, a capital distribution pipeline?
Yeah, instead of a self-funding compounding machine, the cash just flows through and out.
Okay, so if they're paying out 90% or more, they're only keeping 10% or less of their income. How on earth do they gray then? That seems like the next big problem.
It is. It leads directly to what we can call the external growth conundrum.
Meaning they constantly need outside money.
Perpetually. To grow, to buy more properties or develop new ones, they almost always have to go back to the capital markets. They need to issue new stock, potentially diluting existing shareholders.
Especially if their stock price is low.
Exactly. Or they have to take on more debt. So their growth becomes dependent on, well, the mood of Wall Street, interest rate levels, what they call the fickle conditions of the capital markets.
That sounds like the opposite of the financial fortress approach Berkshire prefers, where businesses fund their own growth.
It's completely different. Berkshire wants businesses that generate more cash than they need and can reinvest it themselves without constantly asking outsiders for more money.
Okay, structural payout issues, dependence on external capital. What else clashes? You mentioned accounting complexity earlier.
Yes. This is another hurdle. Standard metrics investors use, like the price-to-earnings PE ratio, are basically useless for REITs.
Why is that?
Because of how depreciation works in real estate accounting. Buildings are depreciated on paper over time, which creates a large non-cash expense that significantly reduces reported net income, the E in PE.
Even if the property is actually increasing in value and generating lots of cash.
Right. So the reported earnings often look artificially low, making the PE ratio misleading. You need to use specialized metrics like funds from operations, or FFO, and adjusted funds from operations, AFFO, just to get a real sense of the cash flow the business is actually generating.
So it adds a layer of complexity. It's not a simple, easy-to-understand business in the way Buffett often prefers, outside his circle of competence, maybe?
It certainly leans that way. He likes businesses he can understand fundamentally and easily. And then there's one more big structural issue, specifically for a corporation like Berkshire owning a REIT: the double taxation problem.
Okay, explain this. Why is it tax inefficient for Berkshire, which is a C corporation, to own shares in a REIT? The REIT itself avoids corporate tax, right?
The REIT avoids tax at the entity level by paying out dividends. But those tax benefits are primarily designed for the end shareholder, particularly individuals. For another C Corp, like Berkshire, receiving those REIT dividends, it's often a different story.
How so?
Generally, those dividends received by Berkshire from a REIT would be taxed at Berkshire's full corporate tax rate. Currently, that's 21%. So right off the bat, a chunk of that dividend income vanishes to taxes before Berkshire can even think about reinvesting it.
Whereas dividends from regular C Corp they own, like Coca-Cola or Apple,
those often qualify for a dividends received deduction, which significantly lowers the tax burden for Berkshire. Investing in a REIT essentially gives Berkshire the worst tax treatment on that dividend income compared to owning shares in a regular company. It creates tax friction they're specifically structured to avoid.
Wow. Okay, so the 90% payout rule prevents internal compounding. The need for external capital adds risk. The accounting is complex, and the taxes are inefficient for them. The case seems pretty overwhelming.
It's a very strong structural case against REITs for Berkshire.
And yet, Berkshire did make a significant investment in a REIT called Store Capital a few years back. How does that fit? It feels like it blows up the whole argument.
Yes, the Store Capital case. It's fascinating because it really is the exception that proves the rule. It shows their thinking in action.
So, why was Store unique? What made them break their own seeming rule?
It wasn't just any REIT. Store focused on a specific niche: single-tenant operational real estate. Think restaurants, gyms, dealerships, places where the operation inside the building is key. But here's the crucial part, the Buffett-like twist.
Okay.
Store's business model contractually required its tenants, as part of their lease agreements, to provide unit-level financial reporting.
Wait, they had to share their store-specific sales and profit data with the landlord, with the store?
Yes. That gave Store's management an incredible, almost real-time insight into the health of each individual property and tenant. It was a unique informational advantage. Most REITs don't have that granular level of data.
That actually sounds like a genuine economic moat. An information moat.
Exactly. It allowed them to underwrite leases better, monitor risk better, and manage their portfolio more effectively than competitors who were just looking at, say, corporate-level financials. They also operated with a margin of safety, typically buying properties below what it would cost to build them new.
So qualitatively, despite being a REIT, it had characteristics of a wonderful business by their standards.
It did. It had a unique edge. And there's another factor here, too, the Weschler-Combs factor.
Right. Todd Combs and Ted Weschler, the portfolio managers Buffett hired.
Yeah. Reports suggest that Ted Weschler in particular was the one who championed the store investment, because he and Combs managed smaller pools of capital within Berkshire compared to Buffett's main pile.
They have more flexibility.
Exactly. They can look at smaller, niche opportunities like Store that might not be big enough to significantly move the needle for Berkshire's overall massive asset base, but still meet those high-quality standards.
Okay, that makes sense. But then what happened? Berkshire eventually sold his entire stake in Store, the pragmatic exit. Why sell if it was such a unique, wonderful business?
Because Store got acquired in 2022. Another company bought them out.
Oh.
And Berkshire was offered a fair price for its shares in cash. So it wasn't a sign of disappointment in Store. It was a classic, rational capital allocation decision.
Opportunity cost again?
Pure opportunity cost. While Store was great for a REIT, it was still ultimately bound by that REIT structure, that 90% payout limitation. By selling, Berkshire got a large lump sum of cash.
Cash that could be redeployed.
Immediately back into Berkshire's own superior, unrestricted, tax-efficient compounding machine, or into other opportunities that didn't have the REIT structural limitations. It actually reinforces the core idea. Even the best REIT structure is ultimately inferior for them compared to their own model or owning a regular compounding business.
That clarifies the Store situation perfectly. Okay, this brings us to maybe the biggest point of confusion for listeners. We hear Charlie Munger, Buffett's longtime partner, quoted as saying, real estate is a lousy investment.
Right.
But then we hear Buffett talking enthusiastically about buying houses. How do we square that? Who is the advice actually for?
This is absolutely critical context. The advice depends entirely on who the investor is, their structure, their scale, their tax situation.
So Munger's lousy investment comment.
That was specifically directed at Berkshire Hathaway. He was talking about why commercial real estate, as an asset class for them to invest in directly or perhaps through REITs, was generally unattractive.
Because of the reasons we discussed. Tax disadvantages for a C Corp, lack of unique competitive edge in a very efficient market, maybe the leverage required.
Exactly. All those structural reasons made it lousy for BRK.
But then you have Buffett's individual view. He's been quite positive about real estate for regular people, hasn't he?
Very much so. He famously called buying a single-family home, especially with a long-term fixed-rate mortgage like the traditional 30-year, a terrific deal for most Americans.
And he even suggested, I think after the 2008 crisis, that buying distressed houses to rent out was a great investment.
He did. He said it was probably as attractive an investment as you can make at that time. But notice the context. He's talking about individuals.
Individuals who can benefit from things Berkshire can't.
Precisely. Individuals can get tax breaks like the mortgage interest deduction, though that's changed somewhat. They can benefit hugely from leverage via mortgages in a way a giant corporation like Berkshire typically wouldn't or couldn't. And individuals can often find small, local opportunities below market value. The economics are totally different for an individual buying a house or a small rental property versus Berkshire trying to deploy billions.
So it's not a contradiction, it's just different advice for different players.
Exactly. Context is everything.
And speaking of context, Munger also sounded a note of caution more recently about commercial real estate, didn't he?
Yes, very much so. Munger's coda of caution came in early 2023. He was quite blunt, warning about potential trouble, even agony, ahead for the U.S. commercial real estate market.
Specifically which parts?
He seemed particularly concerned about office buildings, given the rise of remote work, and also potentially troubled retail properties. He pointed to bad loans building up on banks' books related to these properties.
Which just underscores their preference for businesses with more durable moats, right?
Yeah.
Things less susceptible to big cyclical shifts or behavioral changes like remote work.
Absolutely. It highlights why they value predictability and resilience over assets whose value can be dramatically impacted by these kinds of external shocks and trends.
Okay, so let's try to pull this all together.
Yeah.
Why does Buffett avoid REITs? It really boils down to structure and opportunity cost.
I think that's the core of it. It's not an emotional thing. It's a cold, hard mathematical assessment. The Berkshire Hathaway model and the REIT model are fundamentally opposed in their handling of capital.
BRK is built to retain and compound internally,
A compounding machine.
while a REIT is legally structured to distribute capital externally.
A capital distribution pipeline. For Berkshire, putting money into that pipeline is almost always going to be less attractive than keeping it within their own compounding engine. The opportunity cost is just too high. The structure dictates the outcome in many ways. And it leads to a final thought, maybe something provocative for you to consider, especially given Munger's recent warnings.
Okay.
With all the talk of potential agony and structural shifts in commercial real estate, ask yourself this. Are there any specific niches within real estate today, maybe defined by location or tenant type or industry focus, that could realistically develop a truly defensible, durable economic moat? Something that could actually withstand the kind of pain Munger predicted. Where might that resilience be found in property today?
A very interesting question to ponder. Finding a moat in a sea of potential trouble. Great food for thought. And remember, as you think about market conditions, you can track the overall market temperature using the iOS app Buffett Indicator. Just search for it on the Apple App Store.
And just our standard reminder, all the analysis we've discussed today is based on publicly available information, and it's purely for educational purposes. It is definitely not investment advice.
Please, always do your own research and due diligence before making any investment decisions. And if you enjoyed this deep dive and want more, be sure to subscribe to us on Apple or Spotify podcasts. Just search for Deep Value Investing.